Welcome to the Explainer. We're going to dive into commercial real estate and pull back the curtain on a pretty big secret. How do the pros actually know if a deal is a winner? Because I'll tell you right now, it's not always about chasing the biggest number.
All right, let's jump right in. I want you to imagine you're a real estate investor, okay? You got two deals on your desk. Take a look. Which one are you putting your money on? So, on the surface, this looks like the easiest decision ever, right? I mean, deal B, more than double the return. You'd have to be nuts to pass that up. But, and this is a big but, in the world of professional real estate investing, the easy answer is almost never the right one. Believe it or not, a seasoned pro, they might actually look at this and pick deal A. So why on earth would they do that? Well, because they know it's not just about that big, flashy number at the end. It's about all the things that can go wrong on the way there. And today, we're going to give you the exact framework they use. You're going to learn how to see these deals through the eyes of an expert. Okay, so first things first, let's talk about the #1 rule of real estate investing. Seriously, this is the one concept that drives every single decision. It all boils down to this, the risk-return relationship. You got to think of it like this. Investors, the smart ones anyway, they are not gamblers. For every single ounce of extra uncertainty, for every extra thing that could possibly go wrong, they demand a bigger potential paycheck. It's that simple. More risk has to come with the chance for a bigger reward. So you see, just comparing that 8% to the 20% is totally meaningless without knowing the story behind them. One deal is like buying a safe, reliable blue chip stock. The other, it's like funding a brand new, unproven startup. So the real question isn't just which one pays more. The real question is that extra 12% really enough to make up for all the insane headaches and risks of building something from the ground up? So how do you figure that out? Well, you have to put on your detective hat. You need to know what clues to look for. So let's go through some of the most critical risks, the things you absolutely have to investigate to figure out what a deal is really made of. Okay, first up, tenant risk. This one's pretty straightforward. Who's actually paying you rent? Because let's be honest, if the rent checks stop coming in, the whole investment falls apart. It's the absolute foundation. And look at this. This is what's so interesting. You can have the exact same building, but with two totally different risk profiles. You get a 10-year lease with a powerhouse like Google. Man, that's basically a guaranteed paycheck in the mail every month. But a 1-year lease with a brand new startup? That's not a lease. That's a bet. You're betting on them to succeed. All right, next you got to zoom out from the building itself and look at the bigger picture. We're talking about market risk, because no building is an island, right? The health of the entire city, the local economy, that stuff can absolutely make or break your deal. And this is the perfect illustration of that old saying, location, location, location. If you own an office building in a booming city with tons of different industries, you've got lots of potential tenants. But what if your building is in a tiny town that completely depends on one single factory, and that factory closes its doors? Oof, you are in some serious trouble. Okay, moving on. Let's talk about how the deal is actually financed. This is financial risk. See, most investors don't just walk in and pay all cash. Nope, they use the bank's money. It's called leverage. And leverage is an incredibly powerful tool. But man, it is a classic double-edged sword. It can seriously amplify your risk. Think of it this way. The more debt you use, the more you magnify everything. It juices your potential returns, which sounds awesome. But it also juices your risk. With a ton of debt, a tiny little dip in your income isn't just a small problem anymore. It can completely wipe out your investment. All of a sudden, you can't make that mortgage payment, and poof, the bank takes the keys. So with all these different kinds of risks, how do investors actually put it all together? Well, they create playbooks or strategies. Let's break down the 4 main playbooks you'll see out there. Each one has a totally different tolerance for risk and a different way of trying to make money. This table right here, this is basically the whole game plan. Up top, you've got your core strategy. Think of these guys as playing defense. They're buying the safest, most stable buildings out there for nice, steady, almost bond-like returns. Then you move down to core plus and value add. Now you're taking on a bit more risk, maybe some light renovations, maybe you got to find some new tenants. And then, all the way at the bottom, you've got opportunistic. This is the moonshot, the highest risk, building from scratch, but also chasing those huge 18% plus returns. All right, now for the pro-level move. It's one thing to just spot the risks, but the really smart investors, They actively try to break their own deals, on paper, of course, before they even think about signing a check. Let me show you how they do it. They use something called a sensitivity analysis. It sounds fancy, but it's really just a simple 3-step process to find the deal's Achilles heel. First, they identify the key assumptions, the big what-ifs, like rent growth or construction costs. Then they just change one of those variables. What if rents don't grow as fast as we thought? What if construction costs are 15% higher? And then they see how much that one little change torpedoes their return. It shows them exactly where the deal is weakest. But what about a true catastrophe, like a massive recession? When you're dealing with millions of dollars, a simple what if just doesn't cut it. You have to plan for a total disaster. And that's where they take it one step further with a full-blown stress test. What they do is they model a really ugly downside scenario to find the exact point where the property breaks. And this chart shows you the single most important number. It's called the debt service coverage ratio. In their main projection, their base case, the property is making $1.50 for every dollar it owes the bank. That's a nice healthy cushion. But look what happens in their recession model. The ratio drops below 1. And folks, a ratio below 1 is the danger zone. It means you're not bringing in enough cash to even pay your mortgage. That is the breaking point.
Okay, so we've identified risks, we've walked through the playbooks, we've even stress tested the deal. So what's the big takeaway here? What's the real bottom line for you?
It really comes down to this quote. This is the entire professional mindset in one sentence. The goal isn't to avoid risk. You can't. Risk is how you make money. The real goal is to make damn sure you're getting paid enough for the risks you decide to take. The biggest mistake you can make isn't taking a risk. It's taking a risk for free. And that brings us right back to where we started, that 20% return. Now, when you see a number like that, you won't just see a number. You'll see a question mark. You'll start thinking, okay, where's the risk here? Is it development risk? Is it tenant risk? Market risk? The point is, now you know exactly what questions to ask.